All right, this is not financial advice. This is only financial advice for my one cousin, who I've nicknamed SpongeBob Cousin. And I'll start with why even bother investing as the first topic. Um, and there are three, I think, pretty simple reasons. The first being inflation. This is pretty self-explanatory. Over time, if you only hold cash, like the value of your cash will decrease over time. Even if you have a account that gives you high interest, they'll never give you more than inflation over time. Okay, and the second reason is taxes, specifically income taxes. Um, you know, if as you increase your income, proportionally you will pay more income taxes. It is well, while it is good to increase your income, of course, it's inefficient. It's an inefficient way to hold on to value. This is also why you shouldn't wait until you have a bunch of income in order to invest. You should just start. So long as you don't have high interest debt, you can just start with small amounts at the beginning, because the longer you wait, the more you fight against compound interest. If you want to make up for the fact that you didn't start early, you're gonna have to make much more income to make up for lost time. And then the last reason, I don't know what to call this, like the structure of capitalism. It's kind of obvious, but companies will always try to maximize profit and minimize expenses, the expenses including paying people. And most of the excess, like the profit, will go to owners, and the most accessible and easiest way for you to get those gains is to invest in the stock market, just gaining ownership. Okay. And now I didn't know where to fit this, but it is important, maybe the most important part of this entire video. We're going to talk about affordability rules, because if you don't have money, you can't invest the money. And the most expensive thing you're probably going to buy is housing, rent. Kind of ballpark rule is do not spend more than 25% of your gross income, which is whatever your listed salary is, that amount times 0.25. Do not go over that. Another number that's useful is for fixed costs, so your rent plus transportation, groceries, the rest of your bills and stuff, do not cross 50%. Ideally it would be less than this, but you have to do whatever configuration possible so you don't exceed these numbers, because if you do, you will not have enough money to invest. You might just have trouble living day-to-day life. All right. And the next section is how do you know what stocks to buy? Because there's a bunch of options. And the short answer is no one really knows. And the people who can do this for a long time, like multiple decades, they're all famous and old. And there are very, very few of them. And all of them pretty much recommend to not do what they're doing. There's a lot of smug people and scammers who make it sound easy, or they're dumb. And when the entire stock market is going up, you could pick anything and look good. But this is not. I don't recommend doing what they're doing. There's actually a really detailed video by Ben Felix called, I think it's like The Risk of Individual Stocks, that it explains really well why you're more likely to pick a losing stock. And even if you pick a winning stock in the short term, why it's likely that over the course of like 10 years or 12 years, you're probably going to lose money. And back to the scammers part. Like everyone, there's a lot of people that think this is really really easy, but if you take a look at the top companies over time, there's actually a lot more shuffling around than most people either remember or expect. I could link something for you that's like a nice graphic of it, but yeah, everyone was confident that Philip Morris or whatever and was going to be the top company forever. Everyone's gonna smoke cigarettes. The demand for it, people are addicted to it, whatever. People thought HP and Yahoo and IBM were gonna be the top tech companies forever. Coca-Cola. Well, actually, Coca-Cola is doing okay, but they're not really top dog anymore. So this is why I don't recommend buying individual stocks. However, there is something that I like to say, like it makes sense to buy a financial product where you could hold it forever. And the reason is that one, if you can get away with holding, you can take advantage of compound growth if the expected return is positive. And then two, taxes. So the taxes you pay on stocks is called capital gains. And basically, if you hold a stock for longer than 1 year, you pay much less than if you buy it in the same year and then you sell it in the same year. And so ideally, you would want to buy something where you could hold it forever and not worry about it. Which is why I think I've already recommended you a mutual fund. You could also get ETF, which conceptually is the same thing as a mutual fund, which is just a basket of stocks. I don't recommend just any mutual fund. I recommend an index mutual fund. And I think I wrote down the one I recommended you was a target date fund. It was FDKLX, yeah, Inside Fidelity. All right, and you want to buy something that's all encompassing, like the total U.S. stock market index, or I forget what the international is, like MSCI ex-USA index. But the reason you want it to be as all-encompassing as you can is because you want the gains brought from large events. I can give an example, like the internet becoming more accessible. And this is like in books. So John Bogle's book, The Little Book of Common Sense Investing, he calls it tail events. But basically, I'll use the internet example. So like instead of thinking about, is Google going to be the winner for bidding on marketing stuff on the internet? Is it going to be Shopify? Is there going to be proliferation of small businesses? Is it going to be a marketplace thing like eBay? Is eBay going to beat Amazon? Instead of trying to pick a winner in particular, you just know that eventually some of these changes, like a lot of companies are going to make money, and you just want to take as many of those gains as possible. So if you have an all-encompassing index fund that has most US companies, you're going to take most of those gains. Oh, quick note, I forgot to talk about expense ratios. It's basically how expensive it is to hold a mutual fund or ETF forever, and you want it to be lower. And I already recommended the FDKLX index mutual fund for you, and this is a special type of mutual fund called a target date index fund. And basically, it's a mutual fund, so it's a basket of stocks that contains other basket of stocks inside of it. So it's a mutual fund that contains mutual funds. And what's special about it is that as you get older, and I specifically picked this one for your age, but as you get older, the allocation of stocks to bonds. You could just conceptually you could think of bonds as like a cash equivalent thing that's relatively stable in value. Like the ratio will decrease, so there's going to be more bonds slash cash than there are stocks, and so as you get closer and closer to retirement, the price of the shares that you hold will stabilize, and so you never have to think of, okay, if I'm 35, how much cash should I have compared to stocks? If I'm 40, if I'm 45, if I'm 50, this product will just do it for you. So you just never ever have to think about it. And by default, this is what I recommend to our other family members. And depending on what your age is, they have like a calculator to help you decide which one to get. And so like for my older sister, I recommend a different one because she's like 9 years older than us. And okay, I want to say there are other good options if you don't mind balancing for cash, but I think if you don't want to spend your time doing this, I highly recommend just buying the thing I told you to buy and using your time on doing things you actually enjoy. Okay, and then segue to how to make your life easy. Investing on a regular basis is actually really simple once you set it up. Because you can automate pretty much everything. The easiest form of automation is using your employer's 401k. So if you're a full-time employee, they probably have 401k, and you log in and they let you set a percentage or maybe a fixed amount sometimes to be sent from your paycheck to an investment account, to your workplace investment account. And that's a nice and easy way to get started. If you know you'll have enough money to get all of the 401k match, I'll explain this later, but if you know you have enough money to invest in other accounts, then inside, let's say for example for the Roth IRA and Fidelity that I know you have, you can set an automation inside Fidelity on whenever you get paid. So let's say you get paid on the 1st and 15th. You can set 2 automations, like one on the 1st, take this much amount of money from my paycheck on the 1st, take this much on the 15th, and then after you do that, you just leave it alone and you're pretty much done. And to go back to the affordability rules, let's say you're using the full 50% for fixed costs like your rent, all your bills. Hopefully it's less than that, but let's say it's just 50%. Then I recommend you aim for 20% investing 20% of everything you make. And then the other 30% you just spend on whatever you want to spend it on. And the reason I chose 20%. So I don't know if you've talked about investing with other family members. If you've talked with California cousin, you may have heard her say 15%, which may be what she does. I'm not really sure, but the 15%, I'm pretty sure it's Fidelity researchers that got the 15% number. However, there are a lot of assumptions attached to 15%, and the 2 most important ones are it assumes that you start at 25 years old with no debt. And so if you're older than that, you have to, like the baseline case, you have to invest more. So like if you're 32, I think it jumps up to like 22% or something like that, which is a considerable amount. And it's only 7-year difference, but 7 years not investing is a long, long time. And so there are a lot of assumptions that are being made with this 15% number by Fidelity too. Like it assumes we make 1% less total gains than our parents or grandparents. It assumes like a certain raise percentage every year. It assumes that your living costs, like you're going to spend a little bit more in your 30s and 40s as you get older. And so there are ways that this number can change around. Like if you move to somewhere really cheap during retirement, like of course that changes things, but I think it's a good guideline, and I'd say aim for 20-ish%. Even if you can't do that immediately, I would say like that's a good starting point. Okay, and another way to make your life less stressful is okay, the most important position you have is actually cash. Um, and some people might refer to this as like an emergency fund, but basically, you have this so you don't have to worry about unexpected costs, like if you get hurt, if you lose your job for like an extended period of time, and there's like limited unemployment stuff you could claim. You have this emergency fund, so you have peace of mind and you can invest freely. An easy way to store this is in Fidelity. You can make a non-retirement account called a brokerage account, which is just there's no advantages or anything. It's just a regular investment account. And you could just use that as a savings account. So if you send your money to it, your dollars will automatically turn into SPACs, which is a money market fund. I'm not going to explain what that is, but basically, if you leave cash inside a Fidelity brokerage account, you could just consider it a high interest account. It's like the same thing. And so you could leave your emergency fund in there, just don't spend it unless you absolutely need to. Okay, and then some practical advice. Like, let's say you don't have the 6 months emergency fund yet. So when you first start your new job, send 10% of your income to the 401k, like through your workplace, and then another 10% will go to your savings. And if you want the savings much faster than that, then you could temporarily take some of your 30% personal spending and send it to your savings too. And you could automate this through transfers in your bank, or direct deposit on your work too. Most of the time, you could send more than one. You could set up more than one bank account to send the money to. And then after you have the 6 months, you can stop you could stop sending money to the savings account, the Fidelity brokerage account, and then allocate all of that 10% to savings, like send it to your investment instead. And okay, one important note. So if you invest this amount of time, you're going to be fine in near retirement, even a decade before that, two decades before that. If you want a lot more freedom in, like, let's say your late 30s, 40s ish, you can of course invest more. I highly recommend, if you reach 20% really fast, I highly recommend trying to increase your investment amount by 1% or maybe even more per year, up to like 30 something percent. Of course, you'll have to increase your income, look for opportunities to do this. But I think you and I kind of want similar things. So yeah, I recommend at least trying that. And if you want, if you want financial freedom even faster, I recommend to not disproportionately increase your fixed costs, like your rent and all your other bills, and just increase your investment percentage. Like, let's say in your 40s you want to do a riskier job but still be fine for retirement, like you might want to consider this. All right, and then the last and maybe most complicated section is retirement account types. And unfortunately, in the United States, our setup is kind of complicated, but once you know, like, there's enough similarities between a lot of the accounts that once you know how two accounts work, then you're kind of set. And I will split this up. So I'll start with employer accounts. Okay, so maybe the most important employer account is the traditional 401k. It's an account that uses pre-tax dollars, meaning before any taxes get taken out of your paycheck, you invest from that. and then taxes get taken out afterwards. It's also tax deductible, meaning it reduces your taxable income for the year. And so a simple way to think about this, like if let's say you make $100,000 and you put in $20,000 into the traditional 401k for the year, when you go to pay taxes, it will look like you made $80,000 instead. And you still pay taxes, like when you retire or whatever, you'll still pay taxes when you take money out of it. And it will be ordinary income tax, meaning um, like it has the same rules as income tax. Like if you take out a ton all in one year, you will pay proportionally a lot of taxes. And the reason this account is so important is because usually your employer will give you a match for the traditional 401k specifically. And the match is basically your employer gives you, also puts some money into your 401k for free every time you contribute, but there are different rules for different companies. And so if you're ever confused about the match rules for your company, you should always contact HR and ask, like, what is the optimal amount I should be putting in to get the full match for the year. And then there's the Roth 401k, which is also an employer account. It has no upfront tax benefits, but when you retire and you go take money out from it, you don't pay any taxes at that point. And generally, you should be using the traditional 401k because it has match. Most of the time, it's optimal to or it's the least amount of work to just set an automation for your Roth IRA instead of doing the Roth 401k. But under specific conditions, like if you make very, very little income, like there are situations where it makes more sense to put more into the Roth 401k. The last account, which I think is technically a personal account, but you pay through payroll, is the HSA. The HSA, not every company will allow you to have this account. You're technically supposed to use it for health expenses, but it's a broken retirement account. So it has both the benefits of the traditional 401k. So you do it through payroll, through pre-tax dollars, it gets deducted. You don't pay for any of the growth inside the investment account, and you don't pay taxes for when you take money out of the account. There's one rule where it must be for a health expense, but there's a bunch of weird things with that rules. Like for example, people who have this account, such as I use this account too, you're incentive because the tax advantage is so good. You're incentivized to never actually use it for health related anything. You just invest in it and you just let it sit forever. And there are some crazy people where they save all their receipts for any health care related thing, any product that says you could buy this with the HSA, and you could save those receipts forever. And when you go to pull out money, as long as you have those receipts, you could pull out the same amount of money and spend it on anything. It doesn't have to I think that's a bit too much. I mean, I'm gonna have to pay for health related stuff in the future anyways, so I'm just gonna use it for that. I don't recommend the HSA for everyone, even though it's a broken account. If you have a lot of reoccurring medical stuff, or it's difficult for you to plan saving money to do your doctor visits, or maybe you do a sport or something where you're more likely to get hurt, then I recommend not using this account, because the HSA, you can only have it if you have a high deductible plan, and in those plans, you generally pay a lot more out of pocket for health related stuff. And so if you think this is too cumbersome, just don't use this account. Don't just get the PPO health plan and call it a day. Okay, and then we move to personal accounts. And these are the accounts that you will make by yourself inside Fidelity. And one you already have, the Roth IRA, and the benefits exactly the same as the Roth 401k. No upfront benefits, but when you go to take money out of the account, you don't pay taxes for it. Oh, okay. I forgot to do one thing. So for the Roth IRA, there is actually income limits on it. And so after you make a certain amount of money, you're not supposed to put anything in the Roth IRA, and you have to perform what's called a backdoor Roth IRA. And I can send you a link or a video on how to do this, but I'd say after like $115,000 a year, you should just practice doing it. There's no downside, and as of August 1st, 2025, it's still legal. I'm pretty sure, I mean, they should either remove the income limit or make backdooring illegal, but I'm not sure what they're going to do in the future. And then the taxable brokerage account, which is an account in Fidelity, has no benefits at all. It's just an account. You could invest in it. And oh, one thing I forgot to mention, a big difference between all these accounts, they all have different limits. And they can change, the IRS can change the limits every year. So in 2025, you could put in your 401k combined both account types is $23,500. The HSA, I think it's like $4,300 for this year. The Roth IRA, $7,000. And then the brokerage account is infinite. You put as much money as you want. And to simplify things, I didn't add ESPP, which is Employee Stock Purchase Program, and Roth in-plan conversion. Not every company offers this. Like if you're curious about this, I can explain this to you in person. I also have a text post about how I use these accounts. But basically, they're not worth it unless you can at least fill up the Roth IRA to do the employee stock purchase plan, and then the rest, the in-plan conversion is not worth it unless you could fill every single account on this list. By the way, that text post, I don't recommend copying what I'm doing. I think if you're a full functioning member of society, you should not copy what I'm doing. And oh, another thing. Okay, specifically in the United States, you'll hear a lot of scammers say like, "Oh, there's no point of using these retirement accounts because you have to wait until your 60s to use any of the money. Instead, do this business scam, whatever." However, in the US, our rules are trash. And so we have some things called, it's called like 72T and SEP and the Roth rule, the 5-year rule Roth. I'm not going to explain what these are in this video, but just know the claim that you can't take money out of these accounts before you're in your 60s, just completely false. Even if you want to retire early, you should always fill these accounts first. Most people who say that you shouldn't are scammers. All right. That is a decent amount of stuff. I feel like I did not explain most of this well. If you're confused, that's fine. We could talk more in a call. And oh, before I go, I would like to recommend some books. And the first one I recommend is The Psychology of Money, which actually contains no investment advice at all or financial advice. It's basically a book that gives you a framework to assess financial advice. I think it's very, very useful. And then the second book, we discussed it earlier, which was The Little Book of Common Sense Investing. And the last book is The Simple Path to Wealth. And actually, this one's the most step-by-step, like, do this thing, you dummy type book. But I think it's useful. It's straightforward. Like, he uses Vanguard stuff, but conceptually it is the same stuff as all the things that we've discussed in this video. And I think all the ideas in this book are boring and sound, and that's a good thing. All right. Thank you for listening. Bye.